Monday.com delivered a massive double beat for Q2 2026, but the market, they absolutely punished them for it. Revenue came in at $364.6 million, which comfortably beat the $355.6 million consensus.
Right, and adjusted EPS just crushed it. We were talking 148 cents against expectations of just $1.11.
Exactly. But then you look at management's third quarter guidance, and it missed the mark. They projected $368 to $370 million versus the street's $372.8 million consensus.
Which triggered a swift, just a brutal reaction. The stock plummeted almost 12% in pre-market trading, dragging the price down to around $82 a share.
It's wild. So you have a company putting up these incredible backward-looking numbers, but they get a 12% haircut before the opening bell. Today, we're taking a deep dive into a stack of sources to figure out why.
Yeah, we're pulling from the official Q2 2026 earnings call transcripts, Wall Street equity research reports, and, current financial news analyses.
Our mission today is to unpack this exact paradox. We're going to explore why Wall Street just punished a massive earnings beat, and what Monday.com's radical, honestly pretty painful pivot toward artificial intelligence tells you about the rapidly changing landscape of the software industry.
Because if you're holding enterprise SaaS stocks right now, you really have to treat this as a critical case study.
You absolutely do.
The mechanics of this specific sell-off, they tell us a lot about what the market currently values, and I think more importantly, what they are just no longer willing to pay a premium for.
Right. So let's pull apart this Q2 report first. Because when you look at the raw fundamentals, the headline numbers were genuinely impressive. Like I mentioned, that $364.6 million in revenue, that's a 22% year-over-year increase.
Yeah, top-line growth is solid.
But it wasn't just the top line. They achieved a record non-GAAP operating income of $61.1 million.
And if you dig into the margin profile, it shows a highly efficient engine. Their operating margin expanded to 17%, which is up 200 basis points year over year.
Yeah.
But the most striking figure in the financials, at least to me, is that 89% gross margin.
89% gross margin is staggering. That means for every dollar they bring in, 89 cents is just left over to pay for research, sales, administration.
Exactly. It highlights massive pricing power. And it shows incredibly low marginal costs to deliver their core software.
And structurally, they also crossed a massive psychological and financial milestone this quarter, right? $1.5 billion in annual recurring revenue, or ARR.
Right, crossing $1.5 billion is huge. Plus, they generated $52.3 million in adjusted free cash flow. That represents a 14% margin.
Which is incredibly healthy.
Very healthy.
Yeah.
And they even completed their entire $870 million share repurchase program. So they're returning capital to shareholders, too.
Not to mention, they added record net new customers in their $100,000 plus and $500,000 plus annual cohorts.
Yeah, that upmarket traction is key.
Right. So they aren't just selling to, small design agencies anymore. They are successfully moving upmarket into the heavy enterprise space.
Which normally commands a massive premium from institutional investors.
Because enterprise churn is historically much lower than small business churn, right?
Exactly. When you embed yourself into a Fortune 500 company's core operations, ripping you out is a multi-year headache.
Yeah.
They just don't want to do it.
Right. So this brings us to the paradox we promised to unpack. It's like a student bringing home a report card with straight A+, and they walk in the door and immediately get grounded by their parents.
That's a great way to put it.
How does a company post 89% gross margins, hit $1.5 billion in ARR, beat on both the top and bottom lines, and still see its stock drop 12%? The market reaction feels completely detached from the reality of those Q2 numbers.
Well, the thing you have to remember is that markets are forward-looking weighting machines. Wall Street isn't punishing the Q2 numbers because, those numbers are already in the past.
They're reacting to the syllabus for the next semester, not the last report card.
Precisely. They are punishing the Q3 projections. And this brings us to the deceleration problem that the equity research reports flagged almost immediately.
Right, the guidance miss. Q3 revenue was guided to $368 million to $370 million. And like we said at the top, that missed the consensus of $372.8 million.
Now, on the surface, missing by $2 or $3 million on a near $400 million quarter, it seems negligible.
A rounding error, really.
Right, but it signals a broader, much more troubling trend for growth-focused investors. Look at the trajectory. In Q1, year-over-year growth was 24%.
Yeah.
In Q2, it stepped down to 22%. Now, the Q3 guidance implies growth is dropping heavily, down to about 16% to 17%.
Oof. Going from mid-20s to mid-teens in a matter of months, I mean, that is exactly what spooks growth investors, especially at the valuation multiples they're currently trading at.
And the underlying metrics support that exact deceleration fear. I mean, net dollar retention, or NDR, is expected to drop to around 108% for the second half of the year.
NDR dropping to 108% basically tells you that existing customer expansion is hitting a wall. Historically, SaaS companies of this caliber, they want to see that number in the 115% to 120% range. So what is driving that suppression? Why are existing customers pulling back?
The earnings call transcripts point to a dual headwind. First, they are lapping the pricing increases they instituted in 2024 and 2025.
Ah, right. So those previous price hikes created a temporary sort of artificial bump in NDR.
Exactly. When a customer pays 10% more for the exact same software a year later, your NDR looks phenomenal. But once that year passes, the year-over-year comparison normalizes.
So the pricing leverage has tapped out?
Temporarily, yes, at least on the legacy product.
Right.
But the second headwind is notable softness in the down market.
The small and medium-sized businesses.
Right. SMBs are feeling macroeconomic pressure. They aren't hiring as many people, which means they aren't buying as many new software seats, and they're just scrutinizing every single dollar of their SaaS spend right now.
I want to push back on this panic just a little bit, though, looking directly at the earnings call transcript. Their CFO, Ellen Glazer, specifically addressed this guidance issue.
He did.
He stated, quote, "We prefer to underpromise and overdeliver through a transition." So, are investors just overreacting to a management team that is purposely sandbagging their numbers? I mean, it seems like they're just playing it incredibly safe to avoid a catastrophic miss down the road.
Well, Wall Street hates uncertainty, even if management tries to frame it as conservatism. The pivotal word in Glazer's quote is transition.
Transition, right.
This isn't just a slight tweak to their sales playbook or a routine software update. They are currently executing a massive structural overhaul of the entire company. And the market is pricing in the friction of that overhaul.
Let's get into the mechanics of that overhaul then, because it brings us to this internal earthquake that happened just weeks before this earnings report came out. On July 22nd, MNDY.com announced a sweeping restructuring plan.
Yeah, they slashed their global workforce by approximately 20%.
Which is huge.
It's massive. That is roughly 630 employees let go in a single stroke.
You don't just cut a fifth of your staff during a growth phase unless something fundamentally needs to change.
No, you don't.
They also took a $21.4 million restructuring charge to exit office space in Israel. But management isn't framing this as a desperate cost-saving measure to avoid bankruptcy, are they?
Not at all. They're framing it as a complete philosophical shift in what the company actually does.
Right. Co-CEOs Roy Mann and Aaron Zinman have explicitly stated they're moving away from building, quote, software that helps people manage work to building software that does the work.
Which is the core of their AI pivot.
But let's stop and think about the operational risk here. I read those equity research notes, and the execution risk seems astronomical.
It's definitely giving investors heartburn.
It's like they're completely rebuilding a race car's engine while currently driving at 100 miles an hour on the track. You're shifting the entire backend from passive data storage to active AI compute without letting the end user experience a single glitch.
It's a logistical nightmare.
Right. How do you cut 20% of your workforce without cratering near-term customer support and your sales pipeline? It seems incredibly dangerous.
Well, the market clearly doesn't believe they can do it without bleeding.
Yeah.
Which is exactly why we saw that 12% haircut.
Yeah.
Now, management claims the cuts were surgically targeted at non-customer-facing roles and down-market sales teams. The idea is to allow them to shift all their focus to those highly profitable enterprise clients we discussed earlier.
But even if the cuts are surgical, I mean, morale takes a huge hit. Institutional knowledge just walks out the door.
It does. And the financial kicker here, regarding those cost savings, is even more frustrating for short-term investors.
How so?
That 20% headcount reduction is expected to save them $100 million annually.
Yeah.
But if you look at the full-year margin guidance, they didn't raise it drastically.
Oh, because they aren't letting that $100 million flow to the bottom line to reward shareholders.
Exactly.
Oh, yeah.
Instead, much of that $100 million is being immediately redirected right back into the furnace.
The AI furnace.
Right. They are pouring it into AI talent, which commands an incredible premium right now, and into the massive compute costs required to run these large language models and AI agents.
So let me get this straight. You take the operational pain of firing over 600 people, you absorb the public relations hit and the near-term execution risk, but you don't even get to show investors a massive jump in profitability.
No. You have to feed the AI machine just to stay competitive.
Yeah.
They are choosing to take the pain today to ensure they aren't rendered completely obsolete tomorrow.
It is a highly defensive pivot disguised as an offensive one.
That is a perfect way to summarize it.
So we need to look at the early data to see if this massive, risky engine rebuild is actually bearing fruit. If you are going to put your company and your shareholders through that kind of trauma, the AI better be functioning flawlessly.
Well, according to the Q2 numbers, the early validation is actually there, even if the broader market basically ignored it in pre-market trading.
What's the standout metric?
The most striking metric management shared is that AI ARR doubled sequentially from Q1 to Q2.
Doubled. I mean,
Right.
doubling a revenue segment in a single quarter is rare for a company of this size.
It is. And that AI revenue now represents 17% of their net new ARR.
Wow. So of all the new recurring revenue they added this quarter, almost a fifth of it is directly tied to their new AI products.
Exactly.
But okay, let me play devil's advocate here because we really have to contextualize these percentages. 17% of net new ARR sounds phenomenal. Doubling quarter over quarter sounds incredible.
Right.
But let's look at the absolute numbers based on the analyst math from our sources. Total ARR is over $1.5 billion. If you run the math, the actual AI revenue is likely hovering around just 1% of total ARR.
Yeah, the absolute dollar amount is still just a drop in the bucket compared to their legacy project management software.
Right. So I have to ask, is 1% of your total revenue enough to justify this massive disruption? Is that tiny fraction enough to warrant a 20% staff cut and the anxiety that caused a 12% stock crash?
If you view it statically, just as 1% of today's revenue, the panic seems completely justified. But institutional software investors have learned the hard way over the last decade that you don't value innovation based on today's snapshot.
You value it on the rate of change.
Exactly, the compounding effect of that sequential doubling. In the software sector, if a new vector of growth is doubling sequentially, you have to feed it, even if it actively cannibalizes your legacy structure.
Because if you don't, someone else will.
Right. If Monday.com doesn't build the AI agent that does the work of a project manager, a startup is going to do it. They are intentionally enduring a messy, painful transition year in 2026 to ensure they are structurally positioned to dominate the enterprise space in 2027 and beyond.
And they are making aggressive acquisitions to speed this up, too. The earnings report highlighted their acquisition of a company called One AI for $14.1 million.
Yeah, One AI specializes in voice AI. The mechanical application here is really fascinating.
How does it work?
They're building the infrastructure so that you can transcribe massive corporate meetings, analyze the voice data, and have the AI turn spoken conversations directly into automated, assigned tasks within the Monday.com workspace.
All without a human lifting a finger.
Exactly.
But integrating that into a Fortune 500 company isn't simple. I mean, you can't just download an enterprise AI agent and turn it on.
No, definitely not.
It requires deep integration into legacy systems, custom workflows, and highly sensitive data security protocols.
Which is exactly why their new sales motion is so vital to understand. To handle this, they are deploying something called Forward Deployed Engineers, or FDEs.
Let's break down the mechanics of an FDE because this is a radical departure from the traditional SaaS sales model. Normally, you just give a client a login and maybe a tutorial video, right?
Right, but the FDE model acknowledges that enterprise AI is messy. A massive corporation has data lakes scattered across different servers, bespoke security requirements, deeply ingrained workflows.
It's a tangled web.
So Monday.com is sending these forward-deployed engineers to physically or virtually sit alongside these large clients.
Like a consultant.
Exactly. The FDE acts as a hybrid between a software engineer and a highly specialized consultant. They map the client's custom workflows, ensure compliance, and physically build and train the AI implementations for them.
It's an incredibly high-touch, expensive sales motion. You are paying a high-salary engineer to basically hold the client's hand for months.
It definitely lowers your gross margin on the services side, absolutely. But it creates unprecedented stickiness.
Because they're interwoven into the company's DNA at that point.
Yes. When an FDE custom builds an AI agent that is tied into a client-specific CRM and HR databases, that client is never churning. It builds a relationship with the C-suite that a standard software salesperson simply cannot achieve.
And it also justifies the shift in how they're actually charging for this software, which honestly might be the most important concept in this entire earnings report. They are introducing a seat plus credit pricing system.
This is the existential shift for the industry. Traditionally, software as a service operates on a per-seat model.
Right. If you have 100 employees in your marketing department, you buy 100 licenses or seats to the software.
Exactly. Your revenue as a SaaS company is inherently capped by the physical headcount of your customer.
But with AI, that equation completely breaks. If the AI is actively doing the work, the customer might only need 50 marketing employees. So if you just stick to the per seat model, your AI actually destroys your own revenue.
Which is exactly why Monday.com is saying you pay a base subscription for the seat, but you also buy a bucket of AI credits.
Okay, so how do the credits work in practice?
Every time your AI agent automates a complex workflow, summarizes a massive document, or drafts and sends an email campaign, it burns a credit. You are paying for the computational output of the machine, not just the access for the human.
So the pricing is based on usage and actual output. And according to the earnings call, Aaron Zinman noted that customers are actively hitting their AI usage limits and buying more credits.
That is the ultimate proof of utility right there.
Yeah, because if the AI was just a novelty chatbot, a client might use their free allocation and just stop.
Exactly. The fact that enterprise clients are embedding these agents into their daily workflows, burning through their quota, and then pulling out the corporate card to top up their credits, that validates the entire $100 million reinvestment strategy.
It fundamentally changes how a CFO evaluates software. They aren't comparing the cost of a Monday.com license against a competitor's license anymore. They are comparing the cost of an AI credit bundle against the salary and benefits of a human employee.
And that is exactly why the equity research reports in our sources are so mixed. You have downgrades from firms focusing strictly on the slowing near-term growth, the messy 20% restructuring, and the suppression of the operating margin.
But you also have analysts pointing out that at an 18 times forward PE with an 89% gross margin and a rapidly scaling AI credit usage model, the stock might be historically cheap for its financial profile.
It is a textbook case study of short-term execution risk, violently clashing with long-term visionary transformation.
And the market, which often lacks patience, chose to severely penalize the short-term risk.
They absolutely did.
Which brings us back to why this matters to you. Whether you are a retail investor managing your own portfolio, a tech worker navigating this landscape, or just someone trying to understand the AI revolution, Monday.com is proving that simply adding a conversational AI wrapper to your software isn't enough to survive.
No, it's not.
Thriving in the AI era requires painful, fundamental changes to your company's DNA. You have to change how you operate, you have to change who you hire, shifting from sales reps to forward-deployed engineers, and fundamentally, you have to change how you charge for your services.
It forces us to confront a fascinating, honestly, almost existential question for the entire software industry, building directly on that seat plus credit model we just unpacked.
What happens when the transition is actually complete?
Right. If software companies are successfully building AI agents that literally execute the work of human employees, does the traditional SaaS model of selling user seats eventually become entirely obsolete?
That's the billion-dollar question. If a massive enterprise doesn't need to hire a fleet of junior data analysts because the AI is cleaning and organizing the data lakes, they aren't going to buy those software seats.
Every software company in the world is going to be forced to figure out the exact same math Monday.com is wrestling with today. How do you put an accurate price tag on a digital employee?
It completely rewrites the valuation math for the entire tech sector. It's no longer about how many people log into your software. It's about how much human labor your software successfully replaces. That is a massive paradigm shift to chew on as we watch these SaaS companies report over the next few quarters. Be sure to follow the show for daily earnings coverage just like this, keeping you up to speed on how the market is actually digesting these massive shifts. We'll catch you on the next deep dive.